Hello, everyone, and welcome to 401k Plan Corrections, Correcting the Top 10 Plan Errors. The presenter today is Stephen W. Forbes. Stephen is an ERISA attorney and educator with 32 years of experience practicing and teaching in the retirement plan area. Stephen is currently writing a plan corrections book for ERISApedia.com and is presenting educational seminars and providing private consulting. Previously, Mr. Forbes was Vice President of SunGard Relias, in charge of Relias Education. At SunGard, he taught seminars, conferences, and web seminars on retirement plan compliance, design, and correction. He also helped draft qualified plan 403B, 457B, 409 Cap A, and IRA documents, and was the author of other publications. Stephen was also a tax law specialist at the National Office of the Internal Revenue Service. After receiving his bachelor's degree, he graduated from the LL.M. College of Law. He then went on to obtain a master's of law degree in taxation from George Washington University Law Center. The next slide. Today, I'm Tim Cutchin. I'll be the moderator today. The question board moderator will be Joanne. Stephen will be posting answers to the questions on our website, and that is ERISApedia.com/webcast. All lines are muted. As I said, Joanne will be looking at the question board. If there's an urgent question, I think we'll pop in, but mostly we'll be posting answers on the website. Slides and a recording of the webcast will be available on ERISApedia.com. You will get 2 hours of credit for those who are here the full 100 minutes. You will get a certificate by email in several days. The IRPA takes longer as we have to actually post all the data to the IRS site. That takes longer, so please be patient, and please check your spam folder. People that don't get the certs are likely due to the fact that it's gone into spam, so please check that. And as always, if you have any questions, you can send us an email at support@erisapedia.com. And I think that's it. Stephen, take it away.
Okay, thank you, Tim. Let's get started with talking about the top 10 failures for 401k plans. As Tim mentioned, I'm working on a plan correction book for ERISApedia, and I just was working on the 401k chapter, and I thought it would never end. There are so many errors or potential errors with respect to 401k plans. You could probably write a book just on 401k plan corrections and fill it up with a number of errors. Now, I've identified what I feel are probably the top 10. You may consider something, some errors should fall within the top 10, but you have to have a cutoff somewhere. At one time, I was going to do the 13 most common errors of Baker's dozen, but we figured that that was probably too much to cover within a 100-minute webcast. So anyway, let's get started and address some of these failures and how EPCRS, the IRS's correction procedure, indicates that we should correct these. Now, the methods that the IRS have provided in its procedure are considered or automatically reasonable and appropriate correction methods. You don't have to use them, but I would strongly recommend it. There might be a few exceptions to it. There are situations that are not covered by the procedure, and you have to fashion your own correction methods, and usually what you would do is use the principles drawn from these other correction methods. Now, the first one we're going to talk about is ADP and ACP test failures. We're all familiar with that. Of course, there's a flurry of activity at the beginning of each plan year as we test for the prior year. Now, the time period for correcting ADP and ACP tests is the 12-month period after the close of the plan year, effectively the next plan year. You have the entire plan year. If you correct it either by making corrective distributions or corrective QNet contributions with respect to the ADP or ACP test failure, then you're fine. Your plan is corrected in accordance with the statute and regulations and your plan terms. But if for some reason you don't get it corrected within the 12-month period, then you have a disqualifying defect. Now, sometimes you just have plans that just don't do the test or don't do it within the 12-month period, and obviously they've got a problem. It's a non-discrimination failure, which is kind of a serious failure. But sometimes you have employers that do the test but have incorrect data. In other words, they didn't get the compensation data correct, they didn't get the elected deferral data correct or all of the deferrals, they didn't identify who was highly and non-highly compensated correctly. You have a variety of ways in which plans fail that test. In fact, I can recall a situation years and years ago where I was doing some consulting with a company, and I talked about or recommended that they review the EPCR's correction procedures, and they just looked at me and they said, well, we don't make mistakes. And I guess I kind of chuckled and it looked like I wasn't believing what they said, and I think they got a little upset or a little offended with me, and they said, well, I dare you to find a mistake with our plan. Well, as many of you know, I used to work for the IRS, so that was like throwing red meat in front of a dog. And the first thing I asked for is I said, let me see your worksheet on identifying highly compensated. Within 20 minutes, I found 2 errors, which in a 401k plan would mean your test is incorrect. And obviously you've got an error. Now, the fortunate thing is you can correct this through the self-correction program normally. You can also use these correction methods in VCP, or if you get caught on an audit cap, you can also correct it. Now, correcting the failure solely by means of distributing the excess amounts, which most plans do within the 12-month period, is not an option for correcting it. So you don't have that option left to you. Now, one thing before we get into the correction methods, if you find yourself in a situation where you've not corrected it or not corrected it properly within the 12-month period, before you've, as I would say, fall on your sword and say, okay, we've got to correct under EPCRs, I would find out if you actually really failed the ADP and ACP test. I have found over the years many times people have said, oh, they've called me, very concerned and upset because things weren't corrected within the 12-month period. And I said, well, before we, run to EPCRs, let's see if we can, there's other ways in which we can apply the ADP and ACP tests. And so we've gone through them. And these are some of the popular ones. There's actually some other ones. You could use an alternative definition of compensation for testing. Unless your plan document mandates a definition of compensation for testing, which it shouldn't normally do, you have alternative definitions. You can use a definition which is net of elective deferrals or grossed up for elective deferrals. You can limit comp to that paid while participant. There's different ways, things you can do, and that adjustment may, if not correct, at least reduce the amount by which you fail. There's also what we refer to as the otherwise excludable employee rule, where you divide the plan into 2 and treat it as essentially 2 different plans and apply 2 different ADP and ACP tests. That can often transform a plan which is failing into one which passes. You can also use the statutory early participation rule. There's an example here for the 2016 plan year. X failed the ADP and ACP test. They didn't do it corrected by the end of 2017. So before correcting it, they went and applied, before they went to EPCRs, they went and applied the otherwise excludable employee rule and found out they passed. So No EPCRS correction would have been necessary in that case. So that's probably the first step you ought to do. Now, EPCRS provides two correction methods. One is far less costly than the other one, but we'll go through both correction methods. The two correction methods are the QNEC allocation method and the one-to-one method. As it indicates in the slide, the one-to-one is less costly and therefore much more popular than just a simple QNEC allocation method. So let's talk first about the QNEC correction method. What that requires you to do is to give a QNEC to the eligible non-highly compensated employees adjusted for earnings because you're providing it later than you normally would have done. You provide a sufficient QNEC to raise the average of the non-highlies until they pass the ADP test. Now you allocate it pro rata, In other words, you can't do bottom-up QNECing or some sort of other fancy allocation of the QNECs. If the plan has a match, you don't need to match the QNEC allocation. But of course you have to pass the ACP test, and if you don't pass the ACP test, you can also provide QNEC sufficient to where you can pass the the ACP test. In addition, if you're for purposes of this, employer may not use the otherwise excludable employee rule or the early participation rule or restructuring to reduce the amount of the QNEC allocation that you would need to provide. So if you fail to correct within the statutory or the regulatory 12-month period, this is one method of correction. Let's go through an example here. Company X maintained a 401k plan. For the 2016 plan year, the average ADP and ACP percentages you can see there's a 2.3% gap for the ADP and a 2.2% gap for the ACP. So both of them are beyond what we refer to as the 2% spread test, and therefore they fail and needed to have been corrected by the end of 2017 under the prescribed correction methods, either corrective distributions or making QNECs. Well, they didn't do it, so under the QNEC allocation correction, they can make a sufficient QNEC contribution for the for the ADP test. You would have to do a 0.3% QNEC allocation, raise their average to 3%, and for the ACP test failure, you'd have to make a 0.2 QNEC allocation. Now, as I mentioned, you would have to adjust those for earnings because they're contributed later than they normally would have been if it had been corrected timely. So that's the QNEC allocation method. Now, that's easy enough done. Now, the IRS has also provided an alternative, which, as I mentioned, is less costly. The one-to-one correction method is what it's referred to. Under the one-to-one correction method, you're going to contribute QNECs, but the QNECs are not sufficient to help you pass the ADP and ACP test. The QNEC contribution is just enough to give you license to correct by distributing what you normally would have done within the 12-month period. So what you do is you calculate, based on what you would have done if you had done it timely, the corrective distributions to the highly compensated. So you correct that. And then to allow you to make that corrective distribution, the IRS requires you to make a QNEC contribution equal to the amount of your corrective distributions. So the QNEC doesn't actually correct the ADP or ACP test. It's just the price you have to pay to make the corrective distributions. We'll go through an example. Now, under this one-to-one approach, a plan may not be treated as two separate plans under the otherwise excludable employee rule to reduce the amount of your corrective distribution. Likewise, restructuring is not available. And it's important to note the allocation of this QNEC is treated as an annual addition for 415 purposes for the year of the failure, not the year you actually contribute the QNEC. Now, these are the requirements or conditions for the ability to use the one-to-one approach. The employer determines the amount of the excess contribution or excess aggregate. That's under the ADP and ACP test, as if they had done it under the 12-month statutory period. The employer distributes the amount, including earnings. Now, it's important to note the employer is still responsible for paying the 10% excise tax because it hasn't timely distributed the corrective distribution. That's a given. You still have to pay that. However, if the employer has made a match on distributed deferrals, the plan, in other words, if you have to distribute deferrals and there's match associated with those deferrals being distributed, you need to forfeit those. Regardless of the vesting plus earnings. And now to correct, and that's because you've got a benefits, rights, and features issues there. Now, to correct an ACP failure, the plan also forfeits any non-vested match plus earnings. They would distribute the vested match to correct the ACP, but forfeit any non-vested match, just like you would do under the 12-month period. And then the plan treats any forfeited match in accordance with the plan terms and reallocates it in accordance with how they allocate forfeitures. The plan, but those are some of the conditions for it. Additional requirements for it: the employer contributes as a QNEC, including earnings, the same amount as the plan distributes or forfeits, except the employer needs to contribute the amount. The employer need not contribute the amount of any forfeited match associated with distributed deferrals. You have to see if I can explain that a little bit better than what it says. In other words, you calculate your corrective distributions, and that's how you determine the amount of the QNEC contribution. And that would include any, you see, if you have matching contributions, excess aggregate contributions that you're returning to the employees, you distribute to the extent vested and you forfeit to the extent non-vested. In addition, though, if you have match that is not otherwise distributed but is associated with deferrals that you're returning, that amount would be forfeited. You would not have to, that would not be included in determining the amount of the QNEC contribution. Now, this is where the IRS gets also a little bit more generous with respect to it. In allocating the QNEC, you have some options, because some of your employees may not still be there because this is done later. So here are your options with respect to allocating the QNEC. You can allocate it to the eligible employees for the year of the failure who were non-highly compensated for that year. Just, okay, whoever is non-highly compensated for, in this case, for 2016, we're going to allocate it to them. That's one option. We could allocate it to the eligible employees for the year of the failure who were non-highlies for that year and who were also non-highlies for the year of correction. So they're both non-highlies in 2016 as well as 2018, the year of the correction. Alternatively, the contribution is allocated to the account balances of eligibilities, of eligible employees under 1 or 2, except it is only allocated to those employees who are employees on the date on a date during the year of corrections. In other words, they're still employees. They have not left. So if they're no longer employees, I wouldn't have to give them. That would mean you'd still have to contribute the same amount of QNEC. It would just that those who are still employed would get a little larger allocation. So those are your options for allocating the QNEC. I suspect a lot of people would probably use the third one. Now, in addition, regardless of which group of non-highly compensated employees to which the employer allocates the QNEC, the employees must receive a uniform allocation. So you can't give more to one or more. Remember, the QNACs are really not correcting the ADP and ACP test failure. That's just the price you have to pay to make the corrective distributions. The QNAC contribution made to the non-highlights is further adjusted for earnings because it's obviously later than it normally would be. If the employer uses prior year testing, eligible employees are those employees eligible in the year prior to the year of the failure. So that's how you determine eligible employees. Okay. Example, Company X maintains a 401k plan. For the 2016 plan year, the highly compensated ADP average percentage was 7%. The three highly compensated deferred the following amounts. You can see Ann, Ben, and Dan. This is how much they've deferred. And the average ADP for the non-highlies was 4%. So you can tell that you've actually failed the ADP test. It goes on to say that payroll for all the eligible non-highlies was $1.5 million. X failed to correct the failure by the end of 2017. X decides to correct the failure using the one-to-one correction method. Now, the excess contributions are as follows. You can see how we calculated the excess contributions, but remember you've got this two-step process. You calculate it, and then it's a top-down leveling method starting with the highly compensated with the highest deferral percentages, but to figure out to whom you make the corrective distributions, it's a top-down leveling method starting with the highly compensated employee with the highest dollar amount of elective deferrals. So the corrective distributions are going to Ann and Ben, even though all three of the highlies generated the excess contributions. And we've got the earnings calculations there. Now, to correct the failure under the one-to-one method, the plan will need to make the following corrective distributions. So we distribute the appropriate amount to Ann and to Ben. The plan will also need to make a QNAC contribution equal to the amount of the corrective distribution. So we would contribute $9,694 QNAC. Now, you might say, well, geez, why would we do both corrective distributions QNAC? If we had corrected under just the pure QNAC allocation method, the cost would have been $30,000. So the employer is saving themselves considerable amount of money by using the one-to-one correction method here, and that's why it is considered much more popular. Assume the same facts as in the previous example, except the plan also included a matching formula of 100% of elective deferrals not in excess of 6%. The matching formula is subject to a vesting schedule. For the 2016 plan year, the highly compensated average ACP was 6%, and the non-highly compensated average is 3%, so it obviously fails. X failed to correct the ACP test failure by the end of 2017. X decides to correct under the one-to-one correction method, just like it's doing for the deferrals. The excess aggregate contributions are as follows, and you can see the spreadsheet there. We've got the corrective distribution amounts. We've got the excess aggregates by the three highly compensated, but then again, we use the top-down leveling method starting with those who receive the highest dollar amount of matching contributions to figure out to whom we make the corrective distributions, calculate the earnings. Notice we have vesting here with respect to it. So to correct the failure, the plan will need to make the following corrective distributions. Ann gets $4,540, Ben $2,048. We also forfeit $512 for Ben because he was 80% vested. We distribute to the extent vested, forfeit to the extent not vested. The plan will also make a QNAC contribution for the non-highlies of $7,100. So the corrective distribution plus the forfeited amount. If the plan had used just the simple QNAC allocation method for correcting it, they would have had to have contributed $15,000. So they saved themselves a considerable amount of money by using the one-to-one correction approach. Now, sources of the QNEC contributions. Now, FCRS indicates that these contributions only can come from employer non-elective contributions, but including forfeitures, assuming that the plan document provides for using forfeitures to reduce the amount of the employer contributions. Now, this is a recent change. Previously, the IRS had been very strict with respect to this and indicated that you could not use forfeitures to fund the QNEC contribution. The IRS provided proposed regulations that changed this particular provision, and now you can use forfeitures to help fund the QNECs for this particular type of correction. So that's another positive thing as far as correcting. Okay, let's move on from ADP and ACP test failures. Those are the two correction methods, and let's talk about 401k plan elective deferral failures. We've talked about this in previous webcasts, but nevertheless, this is one of the top 10 failures, so we're going to address these again, and there's always a number of issues. Now, the two most common failures with respect to elective deferral failures in a 401k plan are failure to implement a deferral election. In other words, I as a participant make an election through a payroll snafu or some employer mistake, they fail to implement it or don't do it timely. In other words, I elect to defer 5% and they don't catch it. They don't implement. They don't catch it for several months or maybe even longer than that. There is also what we refer to as improper exclusion. Often this is caused by the employer misunderstanding the eligibility requirements and telling an employee that he or she is not eligible, and then later discovering that they made a mistake and therefore they have to go back and correct it. Now, because these are common errors and 401k plans are so popular, the IRS has actually fashioned correction methods. And actually they have several of them. They've had correction methods for several years, and then in 2015 they came out with additional safe harbor rules. We still have the old rules and we have these new safe harbors. The safe harbors are much more generous, but sometimes you may not qualify for the safe harbors and you have to go back using the general rules. We'll discuss both with respect to it. So as I indicated, unlike most errors, the IRS has actually provided very specific methods for correcting this. Now, to correct it, the employer has to calculate what the missed deferral is. And then there is a calculation. What you contribute in the form of a QNEC is actually referred to as the missed deferral opportunity. And then, of course, if the plan has a matching formula, you would also contribute matching contributions. And of course, as I mentioned, to encourage employers to correct, they have provided even more generous corrections under what they call the safe harbor correction methods. Now, these safe harbor methods are not limited to safe harbor 401k plans. They apply to both traditional as well as safe harbor 401k plans. They're just referred to as safe harbor methods. So which rule you can take advantage often depends on timing of your correction. So we're going to start off talking about the general rules. So we're going to start off talking about an improper exclusion. So they misapplied the eligibility rules. They said you're not eligible, or they think you're part of an excluded class, or whatever the reason is. They've been improperly excluded. To correct that, the employer makes a QNEC contribution equal to the missed deferral opportunity. The missed deferral opportunity under the general rule is 50% of the missed deferral. Now, you don't have to contribute 100%. The reason is the employee got to keep the cash. In other words, the money wasn't withheld from his or her paycheck. So this is why the missed deferral opportunity is 50% of the missed deferral. Now, the missed deferral in a traditional 401k is the average ADP of the group to which the employee belongs So if they're non-highly, it's whatever the average ADP for the non-highly. For the highly, it's the average for the highly. For a safe harbor 401k plan, the missed deferral is the greater of 3% or the highest level of deferral at which the plan matches at 100%. So it's the greater of those. Now, if it's a partial year failure, you calculate it for the portion of the year in which the employee was improperly excluded. Oops, I went too far. Excuse me. Okay, the match correction, the plan must first calculate the missed deferral. So the missed deferral, like I said, for a traditional 401k would be the average ADP or ACP to which they belong. And then they apply whatever the plan's matching formula is to the missed deferral, not the missed deferral opportunity, not the 50%, the full missed deferral, to determine the corrective contribution. That would come in the form of a regular non-elective contribution, subject to whatever the plan's vesting schedule is. For a safe harbor match, it would be in the form of some form of a QMAC. For a regular match, it would be subject to the plan's vesting schedule. Now, depending on when the correction is made, the QMAC will need to be adjusted for earnings. You would normally calculate that match or the earnings from the date that you should have contributed the matching contribution. Now, additional rules for elective deferral corrections. As I indicated, you're going to need to adjust for earnings. The improper exclusion, use the average ADP for the year of the exclusion regardless of whether the plan uses current or prior year testing. So it's the year of the failure that you calculate the average ADP. Corrective contributions are subject to the plan and statutory limits. In calculating the missed deferral, the plan may not use the otherwise excludable employee rule. Correction methods do not apply until after you resolved other qualification failures. In other words, and this is important in applying this, in applying your ADP and ACP tests for the year of the failure, you do not include the employees who were improperly excluded. Even if you correct them during the year, you back them out of the test. They are not included in the ADP or ACP tests. Now, these additional rules also would apply for failures involving failure to implement a deferral election, which we're going to talk about in just a few minutes here. So let's go through an example here. We've got a 401k plan example. This is an improper exclusion. Company X has a 401k plan that the plan administrator misapplied the eligibility requirements and delayed Dan's entry until July 1st, 2017. He should have entered on January 1st. They misapplied. His compensation was $50,000 for the year. The average ADP for the non-highly was 3.5%. The plan's formula was matching formula was 100% up to 3. The plan corrects the elective deferral failure by making a QNAC to Dan's account of $500 plus earning. The calculation is oops, it's not 500. That's a mistake. I keep thinking I've corrected that. It's $437.50. You see the calculation below. So what we did is we took half of his compensation, and we can prorate his compensation. So it's $25,000 for the 6 months of the failure, 3.5% of the average deferral percentage of the non-highly, 3.5 of $25,000 is $875 times 50%. So is $437.50. That's the missed deferral opportunity. Now, the plan would also have to make a corrective contribution for the match. And remember, the matching formula is 100% up to 3. And so they would also make a corrective contribution equal to $750 for the matching contribution. That would not have to be in the form of a QNAC. Now, that's an example for a traditional 401k. Let's go to a safe harbor 401k plan. Same thing, improper exclusion. They have a safe harbor 401k. The matching formula is 100% up to 4. Again, the plan administrator misapplied the eligibility requirements to delayed Ann's entry for 6 months. Should have entered on January 1st. Her comp was $50,000. The plan corrects the failure by making a QNAC contribution of $500 plus earnings. The calculation is the missed deferral is the greater of 3% or the highest level at which you match 100%. So 4% is the missed deferral. 4% of $25,000 is $1,000. The QNAC is 50%, the missed deferral opportunity, or $500. The employer would also have to provide a corrective QMAC contribution equal to $1,000 because you'd apply the matching formula to the full missed deferral. So it would be $1,000 to correct the matching error. Now let's move on to another error, failure to implement a deferral election. In other words, you actually made a deferral election, but for some reason they didn't implement it. Again, this is the general rule. We haven't got to the safe harbors. One of the administrative challenges in dealing with 401k is the timely application of the deferral elections. Things fall through the cracks. Payroll forgets to do it or doesn't do it with respect to all your compensation. Now, the employee, of course, still gets to keep all his or her compensation, but they will need to make a corrective QNAC contribution to correct for the error. The correction is similar but not identical to that for an improper exclusion. Unlike the improper exclusion, you actually know what the employee was intending to defer because he or she made a deferral election, and that forms the basis of our correction. So our missed deferral is whatever your election would be. So they make a QNAC contribution equal to the missed deferral opportunity, which is 50% of the missed deferral. The missed deferral is the amount of your election based on the compensation for the period of the failure. And of course, you would also need to adjust for earnings. Example, company X maintains a 401k plan. Ben made a 5% deferral election effective January 1st. His monthly compensation was $5,000. The plan administrator failed to implement the election, and the error was not caught till May 1st. So they have a 4-month period of failure. The plan would correct the failure by making a QNAC to Ben's account in the amount of $500 plus earnings. And the calculation is false. We figure out his compensation for the 4 months, which is $20,000. Had a 5% deferral election, so his missed deferral is $1,000. 50% of that is $500. That's the QNAC contribution we would make, again adjusted for earnings. The same result would apply if it were a safe harbor 401k plan. Now, we would also, let me note here, we would also have to, if the plan had a matching formula, you would take the plan's matching formula and apply it to the missed deferral, not the missed deferral opportunity. Now, a common question comes up because Roth deferrals are becoming more popular. What happens if the employee intended to make a Roth or actually made a Roth deferral election? Nevertheless, the correction is in the form of a QNAC allocation. That's just how you have to correct it with respect to it. Now, again, failure to implement the match correction, as with the correction for improper exclusion, and as I just explained, the matching formula is applied against the missed deferral. So you first calculate the missed deferral, take the plan's matching formula, apply it to the missed deferral, and then you contribute it in the form of a non-elective contribution. It would be subject to whatever the plan's vesting schedule. And again, you would need to adjust for earnings with respect to it. So assume the same facts as in the previous example, except the plan also includes a matching formula of 100% of elected deferrals not exceeding 4% of comp. To correct the plan, would calculate the matching formula, which would be 100% up to 4. So the employer would make an $800 contribution to correct for the matching contribution failure. And if for a safe harbor, it would be 100% vested. Assume the same facts as in the previous example. Plan also includes another matching formula. In other words, some plans have two matching formulas. So it also includes a matching formula of 100% of elected deferrals not exceeding 6%. So you would also have to make a corrective contribution for that additional matching formula. Since they failed to implement a 5% deferral election, his missed deferral is $1,000, so there would be another corrective contribution for the missed matching contribution for this. You often see this in safe harbor 401k plans where they might have 2 or even 3 different matching formulas. Okay, let's address a couple of other issues with respect to it. Other qualification failures. As I mentioned earlier, in applying either of these rules, you do not apply the EPCRS correction until after the correction of other qualification failures. So you have to make certain that the plan first does the ADP and ACP tests. That's specifically important for improper exclusion because you need the ADP test to figure out what the average ADP of the group to which was improperly excluded. You use that as the basis for calculating the missed deferral. And in applying these ADP and ACP tests for the year of the failure, you back out or you exclude the employees who were improperly excluded or the employees for whom you failed to implement their deferral election. Example, company X maintains a 401k plan for 2017. X improperly applied the eligibility conditions to 2 employees and improperly excluded them from the plan. The plan administrator identified the error in February 2017 and recommended using the EPCRS correction methods. X immediately makes the 2 employees eligible for the plan, so you immediately allow them to start making deferrals into the plan, but you don't make the corrective contributions until you've actually done the ADP and ACP tests, which would be after the close of the plan year. And in performing those tests, you exclude those 2 employees who were improperly excluded. Once you've done the ADP test, you can calculate the missed deferral and make the corrective contributions to the plan. Now, the employer needs to permit the improperly excluded employees to commence elective deferrals immediately. As soon as you discover the error, you allow them to start making deferrals. You only need to wait to make the corrective contributions until you've done the ADP and ACP tests. Alternative correction methods. For an improperly excluded employee or for a failure to implement election, could the employer elect to correct immediately rather than wait for the ADP and ACP test to be performed? Well, EPCRS is quite clear and very specific that you have to wait until after you've done the ADP and ACP tests. However, as EPCRS indicates, you don't have to use their correction methods, although I would strongly recommend it. They could correct immediately because maybe they say, well, we don't want to have to contribute additional amounts for the earnings because if you wait longer, you're going to have to come up with additional earnings. However, you're going to be faced with the difficulty for an improper exclusion and figuring out what the average ADP is. You'd have to kind of do an interim calculation and estimate what the average ADP percentage for that. I wouldn't normally recommend it, but it is possible. Okay, let's talk about another correction method, what we refer to as the brief exclusion rule. Now, again, we're still talking about the non-safe harbor rules, the old rules, which are still in EPCRS and still may need to be used. If someone was briefly excluded from the plan, in other words, it was less than 3 months, then I don't have to make a corrective QNEC allocation for the employee. The assumption is that the employee could make up for the improper exclusion during the last 9 months. Now, to be able to take advantage of this brief exclusion rule, there's three conditions. The employee has the opportunity to make deferrals into the plan for at least 9 months. So this is an error at the beginning of a full plan year. So they have at least 9 months left in the year, and they have to be able to make a deferral election sufficient so that they could defer as much as they could have done for the full 12 months. And thirdly, if the participant would have been entitled to a matching contribution, you do have to make a corrective contribution based on the missed deferrals for that brief exclusion period. So you do still have to make a corrective contribution for the match, subject to whatever the plan and statutory limits are with respect to that. Now, it's important to note that the brief exclusion rule, the old rule, the non-safe harbor rule, which is still effective, only applies with respect to an improper exclusion. It does not apply with respect to a failure to implement the deferral election. Example, Company X maintains a 401k plan. Don is eligible on January 1st, but he is informed that he's not eligible. They catch the error 2 months later and allow Don to start making elective deferrals, so it's a brief exclusion. The non-safe harbor rules available, he has, in this case, he has 10 months left to make deferrals as long as they have to make a sufficiently large deferral election to make up for the fact that he wasn't able to defer during the first 2 months. And if the plan has a matching formula, they'll need to make a corrective contribution for the match based on the missed deferral for that 2-month period. Another example, Company X maintains a 401k plan. Don is eligible January 1st, and he actually makes an election, 4%, but they don't implement it. So it's not an improper exclusion, it's a failure to implement. Under the old general or non-safe harbor rule, the brief exclusion rule doesn't help here. You have to calculate corrective QNET contributions. Let's go to another example. Company X maintains a safe harbor 401k plan with a periodic match of 100% of elective deferrals up to 4% of comp. His comp, is $5,000 a month, and he was improperly excluded for the first 2 months. The missed deferral is $400, 4% of his $10,000 of compensation. They corrected the failure on March 1st. In other words, allowed him to start making deferrals. Remember, since this is a safe harbor 401k, his missed deferral is the greater of 3% or the highest amount contributed with respect to the highest amount to which the plan matches at 100%, highest amount of deferrals. X does not need to make a corrective QNET contribution for the missed deferrals because of the brief exclusion rule. However, they do have to calculate a correction for the match, which would be based on their missed deferral of $400. It would be 100% up to $400, so they'd have to make a $400 contribution for the match. Same result would be on a traditional 401k, but the plan would be, or the corrective contribution would be subject to the plan's vesting schedule. Okay, let's start talking about the safe harbor correction methods. These were added to the procedure in 2015 and then formally incorporated into EPCRS in 2016. Now, many practitioners felt that the IRS's correction methods were still too expensive and created kind of a windfall for the employees since they got to keep their cash. So the IRS came up with more generous correction methods to encourage correction. So they're in addition to the general EPCRS correction methods. Now the safe harbor correction methods are less expensive, and that's what you'd normally use. But there's some times when you might not be able to qualify, and so you're going to have to go back to the general or the non-safe harbor rules. So let's go through these. Let's first start off with the safe harbor brief exclusion rule. Under this safe harbor correction method, an employer may correct an elective deferral failure. Notice one thing: the safe harbor brief exclusion rule applies to both failure to implement as well as improper exclusion. Applies to both. So, without having to make a QNEC contribution for the missed deferrals if you satisfy 3 conditions. First of all, you correct the deferrals. In other words, allow them to start making deferrals or implement their deferral action no later than the first payroll date after the 3-month period in which the failure occurred, or if the employer was notified earlier by the affected participant, the first payroll date after they were notified. Now, the second condition, the employer provides a notice to the employees within 45 days after they correct the deferrals. In other words, after they allowed the employee to start making deferrals or they start implementing their deferral election. If the participant would have been entitled to a matching contribution, then you make a corrective contribution based on the missed deferrals for that brief exclusion period. Those are the 3 conditions. Notice there's no requirement that you have at least 9 months left in the plan year. So this is a rolling 3-month correction period. The 3 months starts whenever the error occurs, and you go 3 months with respect to that. So it not only does it apply to failure, also applies to failure to implement. You've got a rolling 3-month period, so it provides more opportunities for use. Example here. Company X maintains a 401k plan with a periodic match of 100% of deferrals up to 4% of comp. Emma makes a 4% deferral election. Her comp's $5,000 a month. And she makes this election on her entry date of July 1st, 2017, but they didn't implement it for 2 months. They just made a mistake, and so there's a 2-month failure. Under the general or non-safe harbor rule, the brief exclusion rule wouldn't have been available, and you would have just had to correct it. Under this one, you can do it for a mid-year failure. So X will need to make a corrective X will not need to make a corrective QNEC for the missed deferrals because of the safe harbor brief exclusion rule. However, X will need to make corrective contributions for the match based on the missed deferrals, and you'd have to make a $400 contribution for the match. Same result in a safe harbor 401k, except the match would be 100% vested. Assume the same facts in the previous question, except in this case, X improperly excluded Emma, and they told her she wasn't eligible. They caught the error 2 months later. They still will not have to make corrective QNEC contributions for her because of the safe harbor brief exclusion rule. However, they will have to correct for the match, just like they had to do in the previous example. So as you can see, this rule is much more generous. The only negative, so to speak, with respect to it is I have to provide this 45-day notice. And the 45-day notice is from the date you correct the deferrals, when you start making correct deferrals. So in this case, it would be September 1st would be the time period from which you would measure the 45 days, not from the date you make the corrective. You're not making corrective QNECs except for the you just don't make the corrective QNECs. That's the date from which you measure the 45 days. Okay, there's another safe harbor rule. This is for elective deferral failures that are beyond the brief exclusion period, so they're beyond 3 months, and but they have an outside limitation with respect to it. You have to correct by the end of the self-correction period for insignificant failures, which is, or excuse me, for significant failures, which is the end of the 2-year period following the plan year of the failure. So it's beyond the brief exclusion period, but the end of the 2-year period following the plan year, the 2 years following the plan year in which the failure occurred. So for elected deferral failures that have not been corrected within the 3-month period following the date, under this safe harbor method, an employer makes a corrective QNAC contribution for the missed deferrals, but the amount is 25%, not 50%, so they've cut in half the amount of the corrective QNAC. Now, you have to satisfy 3 conditions. The employer provides the employee the opportunity to make elected deferrals under the plan not later than the earlier of the last day of the 2nd plan year following the plan year in which the failure occurred, or if the employer was notified of the failure by the effective employee the 1st payroll date on or after the end of the month after the notification. Number 2, the employer provides a notice of the failure to the affected participants within 45 days after the date in which the employer implements the participant's deferral election. So that's the date from which you measure the 45 days. And thirdly, if the employer, if the employee is entitled to a match, you provide a matching contribution based on the missed deferrals. And that's still calculated the same way. There is no reduced cost for correcting the match. Example, Company X maintains a safe harbor 401k plan with a periodic safe harbor match of 100% of elected deferrals not exceeding 4% of compensation. Ben makes a 5% deferral election. His compensation is $5,000 a month on his entry date of July 1st, but X failed to implement the election until 6 months later, January 1st, 2018. To correct, X will need to make a corrective QNAC for the missed deferrals equal to $375 plus earnings, calculated as follows. We take the missed deferrals, which is, see, it's a safe harbor 401k plan. Well, he has a 5% deferral election. 5% on his $30,000 of compensation is $1,500. That's the missed deferrals. The missed deferral opportunity is 25% of that, so it is $375 plus earnings rather than $750. X also makes a corrective QMAC contribution for the match based on the full missed deferrals, which would be 100% up to 4% or $1,200. The result would have been the same in a traditional 401k plan, but the corrective match would have been subject to the plan's vesting schedule. So as you can see, it cuts in half the cost of it. Now, as part of this, it's important to note you also have to provide the 45-day notice. And the 45-day notice would be measured from, this, in this case, January 1st, 2018, when the corrective deferral started. Now, assume the same facts as in the previous question, but X improperly informed Ben that he was eligible on January 1st, 2018, rather than his correct eligibility date of July 1st, 2017. They discovered the error. They calculate the missed deferrals to be $1,200. Since this is safe harbor 401k, it's the highest level at which the plan matches at 100%. Well, it's the greater of 3% or the highest level at which they match at 100%. So it's 4% is the missed deferral, 4% of $30,000 is $1,200. The corrective QNAC contribution would be 25% of that, or $300 plus earnings. And then they would also make a corrective contribution for the match of $1,200 for this period of time. Let's go through an example for a traditional 401k plan. Assume the same facts in the previous question. X improperly informed Ben that he was not eligible on July 1st, which should have been his entry date. The average ADP for the employees for the non-Hileys was 3.5%. So that forms the basis for our missed deferrals. 3.5% times 30,000 is 1,050. 25% of that is $262.50. That's our QNET contribution plus earnings. And then you would also make a corrective contribution for the match of 1,050 because that's calculated on the full missed deferrals. Now, I've mentioned the notice requirement. This slide identifies what needs to be included in the notice, the information. You can do it in one page, this particular notice. Now, there's also a safe harbor with respect to plans which have an automatic contribution arrangement. And this is actually even more generous than the other IRS correction methods. Under this safe harbor, the employer does not have to make a corrective contribution for the elective deferral failure. And when we're talking about elective deferral failure, it's failure to implement or improper exclusion if the following conditions are satisfied. First of all, the correct deferrals begin by the first payroll date on or after the earlier of 9.5 months after the end of the plan year in which the failure first occurred, or the last day of the month after the month the affected employee notified the employer of the failure. So as long as correct deferrals are commenced by that, so if the employee was unaware of the mistake, you get until 9.5 months after the close of the plan year in which the failure first occurred. The employer provides a notice, again, a 45-day notice. And thirdly, if the eligible employee was entitled to a match, you have to make a corrective contribution for the match based on the missed deferrals for that entire period of time. But as you can see, that I don't have to make any, it's not a 25%, I don't have to make any corrective QNET contribution for the missed deferrals under this safe harbor. Let's go to an example to illustrate this. Company X maintains a QAC, a qualified automatic contribution arrangement with a matching formula of 100% on the first 1% and 50% for deferrals between 1 and 6. And becomes eligible on January 1st. She makes neither an affirmative election nor a contrary election. She does nothing. Her compensation is $5,000 a month. Now, what they should have done is implement an automatic 3% deferral, because she neither made an automatic nor a contrary election. But they didn't do anything. X will not need to make a corrective contribution for the 2017 missed deferrals. I forgot to make. They caught it beginning of January. However, X will need to make a corrective contribution of $1,200 for the matching contribution on the missed deferrals, and the calculation is set out there in the slide. So you do calculate the missed deferrals, missed deferral would have been the automatic contribution percentage. And of course, they will have to provide a 45-day notice to Ann. Now, they also provide some special earnings calculation rules for plans with automatic contribution arrangements. For 401k plans using automatic contribution features, you can use the plan's default investment alternative for purposes of calculating earnings on the corrective contribution. However, if that default investment alternative has a loss, you do not adjust for the loss with respect to that. And the notice requirement is similar but not identical for plans with automatic contribution arrangements. The slide indicates the 5 items that need to be set out in the notice. Now, the safe harbor rule for plans with automatic contribution arrangements has a sunset. The other safe harbor rules don't have a sunset. This one is only available with respect to failures that begin on or before December 31st, 2020. At that time, the IRS will decide whether they're going to continue it or modify it or just eliminate it. So it's got a sunset provision. The other safe harbor rules do not. So this little chart kind of outlines, summarizes all the different correction methods. The one unfortunate thing about these safe harbors, that they're more generous, or to the employer, they cost less, but when you throw them on top of the general rules, it's just a lot of rules to remember. So you've got the non-safe harbor brief exclusion rule there, and whether a notice is required, and just in the corrective contributions. That'll just help kind of remember which rule is applicable. And then in calculating your corrective contributions, I created another chart here based on traditional and safe harbor 401k plans, how you calculate the corrective contributions. Now, what EPCRS doesn't really address, although it's probably easy to figure out what the correction is, what happens if the employer failed to implement a change in a deferral election? So I've got let's say, 4% deferral election, and I up it to 5%, but the plan continues to just withhold 4%, so they don't implement my change in my election. How do you correct that? Like I said, they don't specifically address it, but the principles are the same. You just calculate the missed deferral based on the change which they failed to implement. Let's go through an example here. Company X maintains a safe harbor 401k that provides a safe harbor match of 100% of elected deferrals up to 4% of compensation. Effective July 1st, Mary increases her deferral election from 3 to 4%. Again, her comp's $5,000 a month. The plan fails to implement this change until 6 months later. So the missed deferral is based, this is the 1% that they failed to implement. So 1% based on her 6 months of compensation is $300. Under the safe harbor rules, you take 25% of that, $75 plus earnings. You would also make a corrective QMAC contribution because it's safe harbor, and that would be calculated on the full missed deferral, so that would be $300. And of course, you would adjust for earnings, and you would also need to provide the 45-day notice since you're using the safe harbor rules. Now, question here, you see the note at the bottom. If the employer had caught the error within 3 months, I think you could arguably take advantage of the safe harbor brief exclusion rule and avoid making any QNAC for the missed deferral. You would still have to correct for the matching contribution. So that's something important to note there. What about a failure to implement a decrease in the participant's deferral election? Again, that's not addressed in EPCRS, but so you have to kind of fashion your own correction. The way in which you would do, I would recommend you do it, is you return the inappropriately withheld contributions to the participant. So you just return those plus earnings. Now, if there's enough time left in the plan year, you could probably make some adjustments so you could have the employee end up where he or she intended to be. But if there's not enough time in the plan year, then I think you'd have to return it. Now, the plan should report that on a 1099 or with the code 7. Let me change that. I think the better code to put on is a code E, which is for EPCRS, for corrective distribution, so it's not subject to the 10% penalty. I would put a code E, not a code 7 with respect to that. Some people might put a 7, but I'd put a code E. With respect to the employer contribution allocated in error, in other words, if they provided a matching contribution based on this decrease, you would go ahead and forfeit that and then use it in accordance with the plan terms of how they allocated forfeitures. Okay, let's talk about earnings. We talked about the special rule for earnings for safe harbor corrections with plans with automatic contribution arrangements. Let's talk about it in terms of other plans. Whenever a correction requires a corrective contribution, you have to adjust for earnings. Now, reasonable estimates are permitted. Generally, you don't adjust for losses, but you potentially could. The period of the failure is the date from which the failure began through the date of the correction. Generally, that would be, you look at the type of contribution and when it was normally made under the plan or when it was made to the other employees and calculate the earnings from that date with respect to it. Now, there's some special rules for calculating earnings on 401k deferrals and matching contributions. For convenience, since deferrals are contributed with each payroll and to calculate from each payroll date would be take an enormous amount of time, you can use the midpoint in the plan year. So if the error was for the full plan year, rather than calculating it from each payroll, you can treat the deferrals as if they were all contributed mid-year. Or if you have a correction period, you take the middle of the correction period and treat the deferrals as if they were all contributed on that particular date. Alternatively, if you could calculate it from the beginning of the plan year of the error. This is for elective deferrals and match, but then you could calculate your earnings rate as 1/2 of the normal earnings rate. You can use either one of these alternative methods for deferrals. Now, some other rules that will help you. Like I said, there's not just one mandated way. There's a number of rules you can use based on how your plan is set up. If you have multiple investment options, which most 401k plans do, if the employee actually has investment choices, you base it on whatever his or her investment choices. If most of the employees are non-Hileys, the plan could choose to use the investment option with the highest rate of return. If the employee doesn't have an investment choice, the rate can be the average of the earnings rates for all investment options under the plan, weighted by the portion of the plan assets actually invested in the various funds. Those are some ways you can calculate earnings. Now, for the safe harbor correction methods, in addition to the one with respect to automatic contribution arrangements, they also said you can use the default investment alternative as the basis for calculating earnings. Or you can go and use the other methods set out within EPCRS. Now, corrective QNEC contributions, prior to the issuance of the safe harbor rules, as we know, the corrective contributions were 50%. With the issuance of the safe harbors, the corrective QNEC contribution depends on when the corrections take place. And then this is just a chart helping us, first 3 months, you've got the brief exclusion rule. Between 3 months and 2 years, you've got this 25% rule. After that, you're back with the general rule there. And again, if the plan includes a matching feature, you would need to make corrective contributions for the match, and you would need to adjust it for earnings. Okay, let's move on from elective deferral failures. Those are the elective deferral failures are fairly common, and unfortunately there's a lot of rules that apply with respect to it. Now, another very common failure is failure to apply the deferral election to a bonus. I've received a lot of questions with respect to that. Unfortunately, the IRS just kind of abdicated their responsibility here and just didn't address this very common failure, but they didn't provide any guidance. It's a little bit different because it's oftentimes just a one-time payment, And I think the IRS just struggled with figuring out how to articulate a correction with respect to it, so they just punted on it. I've talked to a number of practitioners, and to tell you the truth, I've found a variety of responses with respect to it. So this is what I feel that you should do. There's nothing in EPCRS. You might take a slightly different position with respect to it. As I mentioned, it's a common error. And the reason it is because sometimes they just forget to apply the participant's deferral election to the bonus, even though that's what the plan terms say they should do it. Now, factors that you would take into consideration in fashioning a correction here are, does the plan treat it as a separate payment, just separate, or is normally it's just part of the, it's just another payroll? That's a factor that you might take into consideration. And when the bonus is payable, you'll see in my examples. Right. So the question comes up, could I use either of the brief exclusion rules with respect to a failure to apply a deferral election with respect to a bonus? My feeling is that if the bonus is payable at the end of the year, that I don't think the IRS would support an application of either of the brief exclusion rules. Well, we know that the non-safe harbor wouldn't apply because you don't have 9 months left in the year. But even the safe harbor rule, I don't think would apply. An underlying principle of both brief exclusion rules is you still have time to make up the deferrals, and you really don't with respect to a bonus that is payable at the end of a calendar year. And that's further strengthened if the employer takes the position that it's kind of a separate one-time payment to which they apply a separate, deferral election. Now, if the bonus is paid early in the year, I think arguably, and they treat it, and the employer treats it as just, part of the normal payroll process, arguably you might apply the brief exclusion rules to it. It may be a little aggressive, but since the IRS hasn't issued guidance, I don't think it's unreasonable. So if you had a bonus paid, like I said, in the first 3 months, you might take the position that you could apply the brief exclusion rules. Probably the safest course of action is to apply the safe harbor rule, which is the 25% QNet contribution, or the general rule, which would be 50% if it's beyond the 2 years. So that's my feeling with respect to it. Let's go to some examples here. And participate in their company's 401k plan and makes a 5% deferral election. The plan defines compensation as W-2, so that would include bonuses. There's bi-monthly payroll with a bonus paid at the end of the year. Ann's bonus is $10,000. The employer failed to apply her deferral election to her 2017 bonus. I would argue that the brief exclusion rules are really not available here. Some people might disagree and take a much more aggressive approach, but I would. Ann's missed deferral here is $500, 5% of her $10,000. So you could apply the safe harbor correction, make a contribution of $125 plus earning 25% of $500. You would also have to provide the notice. Plan also would have to make a corrective contribution if there were a match associated with this. Now, let me backtrack. If the bonus were payable, let's say in January or February, early in the year, as I mentioned, you might be able to take the position the brief exclusion rule applies. However, remember, if you do that, what you're saying is the correct deferral started with the next payroll, and so you'd have to give the notice real quickly if you wanted to use the safe harbor rules. Okay, let's move to a different failure, 402G failure.
Stephen?
Yes.
Tim, prior to moving on to the next one, Rather than trying to figure out what to do if the problem happens, why don't you set up the plan to keep it from happening in the first place? And say that you cannot make the 401k elective deferral out of bonus.
You can do that because it's important to note that for deferral purposes, I'm not talking for testing purposes, for deferral purposes, your definition of compensation does not have to be non-discriminatory. It just needs to be reasonable. In other words, you may say, okay, it's W-2 compensation excluding bonuses. We're not going to do it, and that way you don't have that potential error. The reason that a lot of plans favor including bonuses is that oftentimes the highly compensated employees are the ones that are receiving the bonuses, and they like to make deferrals with respect to that, sometimes generous deferral actions. But that is an option to avoid that particular issue. But just to elaborate on that, it's not just bonuses. Sometimes employers say, well, this is a special payment, and I'm not going to apply the deferral election, or the payroll department doesn't apply the deferral election. But if the plan defines comp as W-2 compensation, then the employer doesn't have that latitude just to unilaterally ignore those special payments or special compensation items. But you're correct. You could do that and avoid this issue altogether. Okay, let's talk about 402G correction now. If an employee defers in excess of the 402G limit, for 2018, it's $18,500. We all know you have to distribute the excess deferrals by April 15th of the following taxable year. That's the deadline. That's an absolute deadline. Now, there are some special taxation rules that apply with respect to it. The excess deferral is includable in income in the year of deferral, and the earnings are includable in the year of distribution, so you have to report those accordingly on separate 1099-Rs. Now, distribution of the excess deferral is the only way in which you can correct this. There's no other alternative. You have to distribute by this deadline. It's an absolute deadline. You miss it, it's a disqualifying defect. But we all know that employers fail to do it. They fail to distribute April 15th, or don't distribute the entire excess deferral. They may have a calculation error and didn't distribute that. My son just had this situation occur with respect to him. So if the plan distributes the excess deferral after April 15th, it's a disqualifying defect. Fortunately, EPCRS provides a correction with respect to that. And it basically is authorizing you to do what you should have done by April 15th, but you're doing it after April 15th. So all it's doing is just giving you the permission to go ahead and make that corrective distribution that you should have done by April 15th. Now, EPCRS, unfortunately, doesn't change the tax consequences with respect to it. If I miss the April 15th deadline, then the employee is subject to double taxation. The excess deferral is still taxable in the year of deferral, but it's also taxable in the year of distribution. You don't get any basis with respect to it. Now, as I mentioned, the self-correction method of correcting is just to go ahead and make that distribution. But as I mentioned, it doesn't change the double taxation consequence with respect to it. The employee is still you have to tell the employee that he or she is still taxable in the year of deferral, and then they'll get a 1099-R for the year of distribution, and it's taxable again with respect to that. Example, Company X maintains a 401k plan for 2017. Kathy defers $20,000. The 2017 limit was $18,000. The plan does not distribute the excess deferral, the $2,000 plus income, by April 15, 2018. They discovered the error later in 2018. The plan is subject to disqualification. However, X may correct by distributing that excess deferral, even though they're beyond the April 15th deadline. But the corrective distribution doesn't help with the corrective or the double taxation. Kathy is taxable, still taxable for the $2,000 in 2017 as well as in 2018. The income is taxable in the year of distribution. Now, there's a couple of other things to note. A distribution of excess deferrals, whether it's before or after April 15th, to a highly compensated is still in the ADP test. However, a distribution of excess deferrals to a non-highly is not in the ADP test. Those is just something to note. Okay, that's the 402G correction. Let's talk about the early inclusion of an otherwise eligible employee. In other words, they let them in earlier than what the date he or she should have entered the plan. That's an operational error. So they commit an error when they let the employee in early. It could come about where the employee has not met the minimum age and service requirements, or he or she has met the eligibility requirements, but they let him in earlier than the entry date. Sometimes you find employers or HR departments think that they have the flexibility of ignoring the eligibility conditions and just letting somebody in early because the employee asked to be let in early or they negotiated something. In either case, it's a disqualifying defect. Now, the IRS has provided, fairly generous correction here. The employer may amend the plan. If they've let somebody in early, they may amend the eligibility provisions retroactively to allow the employees who they allowed to come in early. They can just do what we refer to as a conforming amendment. They just amend retroactively to allow them to remain in the plan. Now, it has to meet the qualification requirements of 401A and would have satisfied the qualification requirements if it had been done timely. And most importantly, the employees affected by this retroactive amendment are predominantly non-highly compensated employees. So I can just do a retroactive amendment just to allow them in. Now, I don't have to allow everybody in, so you have to carefully draft this retroactive amendment so that it only allows those employees that you accidentally let in early or improperly let in early. You don't want to open the floodgates, in particular in a 401k plan, because now you're going to have other errors with respect to it. Now, normally when you have to do an amendment to correct a plan, you have to file under VCP, but this is permissible under the self-correction program. This is one of the few exceptions that allows you to adopt an amendment to correct it. Again, though, the employees have to be predominantly non-highly compensated. So example, employer X maintains a calendar year 401k with 1 year age 21 eligibility conditions and semi-annual entry dates. In 2017, they hired 4 new programmers. And despite the plan terms, they permitted them immediately to enter the 401k plan. The makeup of the new hires is 3 non-highlies and 1 highlies, these new hires. Now, they identified the error, so X can correct by adopting a retroactive amendment that allows those 4 employees, not others, just those 4 employees in early because they are predominantly non-highly compensated. Now, an advantage of this retroactive amendment, so you don't have to distribute this money back out of the plan, is also I've oftentimes already run an ADP and ACP test. I won't have to go back and rerun that ADP and ACP test. Assume the same facts as in the previous example, but the makeup of the new hires was 2 highlies and 2 non-highlies. So it's not predominantly non-highlies. So the option of adopting a retroactive amendment is not available here. Because I don't meet that particular condition. So what's an alternative correction approach here where I don't meet the requirements? An employer, if you have an early inclusion failure here, then you would correct by returning the elective deferrals plus earnings to those employees that shouldn't have made those, forfeiting any employer contributions, including match, that they were not entitled to, and then you're going to have to back them out of the ADP and ACP tests if you've already run those, and so you're going to have to rerun those tests. Now, when returning the elective deferrals, the plan would need to use a code E on the Form 1099-R to avoid subjecting the employee to the 10% penalty tax. So, unfortunately, that's how you'd have to do it in that case. Now, let me throw out another correction method that you might use. Let's look in this example where the retroactive amendment's not available. You could do the retroactive amendment for the non-Hileys, let them keep the money in the plan, and distribute the deferrals and forfeit the employer contributions for the highly compensated. The advantage of that is that I don't have to go back and rerun the ADP and ACP tests, because you would obviously, if you passed it before, you'd still be passing it. So here's an example. Employer X maintains a calendar year 401k plan with eligibility conditions of 1 year of service and age 21. The plan's entry dates are January 1 and July 1st. They hired 4 new programmers. They permitted them to come in early. The makeup's 2 Hileys, 2 non-Hileys. So I can't use the retroactive amendment. What I could do is just return the elective deferrals to these 4 employees plus earning, forfeit any matching contribution. And then I articulate this as potential other alternative correction method that you might use. Okay, let's talk about compensation. We talked about this a little bit already. Unfortunately, one of the more common errors you see in 401k plans as well as other plans is compensation. Unfortunately, there's so many different definitions of compensation. They're very difficult for employers to keep track of, and oftentimes the employers don't understand what definition is set out in the plan document. Now, it's important to understand which definitions you're using. The testing definitions must be non-discriminatory, but they don't have to be set out in the document, and really shouldn't be. So you have flexibility, but you must use a non-discriminatory definition of compensation. You can use the 415 definition. You can use W-2 or federal income tax withholding wages. So there's basically 3 safe harbors, 415, W-2, or federal income tax withholding wages. There's some modifications that you can make and still have it be a safe harbor definition. You can either gross up or net out for elective deferrals. There's certain fringe benefits that you're able to exclude with respect to it and still have it treated as a non-discriminatory definition. And you have to use a non-discriminatory definition for testing. And so if you use a definition which is not non-discriminatory, then you're going to have to go back and redo the ADP and ACP tests with one of the non-discriminatory definitions of compensation. As I've already mentioned, you don't have to use a non-discriminatory definition for deferrals. It need only be reasonable. So you have to be and that's just something you have to take into consideration in designing your plan. So if an employer doesn't allocate contributions, including deferrals, in accordance with the plan definition of compensation, they have failed to comply with the plan terms. For a discretionary contribution, you can either reallocate based on the correct definition of compensation to bring everybody up to the uniform percentage provided in the plan document. Or you can contribute additional amounts to bring everybody up to the highest level so that they have a uniform provision. If it's a fixed contribution, you're going to have to make an additional contribution to correct it. If it's deferrals, if you use the wrong definition for deferrals, you're going to have to correct by using the rules for missed deferrals. If the plan doesn't use a non-discriminatory definition for testing, as I mentioned, you're going to have to rerun the ADP and ACP test. And if you're beyond the 12-month correction period, you're going to have to use the rules for correcting ADP and ACP test failures. Roth deferral failures. If an employee elects to make a Roth deferral and the plan nevertheless makes it a pre-tax deferral, they're going to have to reclassify that. And if they've already issued the W-2, they're going to have to amend the W-2. And then the employee, if he or she has already filed their tax return, would have to amend their tax return. Matching contribution failures. We've talked a lot about matching contribution failures, but generally, if a plan fails to make a matching contribution, let's just say it's not a deferral failure, they just failed to make it, and they're required to under the plan, they have to make up that contribution plus earnings. If they use the wrong definition of compensation in allocating the match, they're either going to need, if it's a discretionary contribution, they're going to have to reallocate the match or bring everybody up to the proper allocation by making an additional contribution. If they've contributed too much, they're going to need to forfeit. As I indicated, if you do a makeup contribution, you need to adjust for earnings. Okay, I think we've reached the end of the presentation. I know this was a lot to take in for 100 minutes. Anyway, I appreciate you attending the seminar. Let me turn over the time to Tim.
Okay, thank you, Stephen. Towards the end there, I got what I thought was kind of an interesting question, and it deals with the failure if someone is let in early and you want to fix by retroactive plan amendment. And the question is, if a participant is let in early due to a retroactive amendment, do they need to be includable in the code section 401A4 testing?
Yes. Yes. They're in the plan. So if they received a contribution or they made deferrals for the year, you would include them in testing. Absolutely. Okay,
but let's just parse this out a little bit.
But excuse me, Tim. Usually, I'm sorry to interrupt you, but
sure.
Usually it's not going to be a problem because these are predominantly non-highlights, so it's normally going to help, not hurt.
Right.
Go ahead with your
right.
question.
But the damage on 401A4 doesn't happen till the employer actually allocates a contribution. So it's possible to have different rules, isn't it, for when people are eligible for 401K versus non-elective? And couldn't you craft the amendment in such a manner that solely for purposes of 401K, we're going to let these people in early? For non-electives, we're not.
Sure.
Okay.
If you, in particular, if you haven't made those contributions, you may want to do that. You may say, okay, we're going to amend it, let them stay in for deferrals, but for employer contributions, you still have to meet the plan's eligibility conditions. But yes, you could further tailor that particular amendment.
Okay, thanks. Joanne, did you find any questions that were particularly interesting?
We actually had several, so I think probably what we'll do is what we had mentioned earlier is to have Stephen answer these, and we'll post them on our website under webcast in a Q&A format.
Okay. So I think that's pretty much it, Stephen. Any final thoughts? I guess maybe I'm going to put you on the spot. We have a lot of people asking when your book is coming out, so I'm going to put you on the spot and have you come up with an ETA.
I'm planning on having this thing done hopefully by the end of summer. I should be able. There are just not only going through all the EPCRS correction. I mean, I just took 10 errors from 401k, and you can see how many things we discussed there, and you take this 10 and multiply it by another 10, and you can get an idea of just the 401k plan errors, not talking even about other types of errors. But it's so that's my plan. I'm trying to address not only those errors that are I identified in EPCRS, but errors that you confront, but the IRS just doesn't happen to provide a correction method, and providing you a recommended correction method.
Okay, thank you. Well, I think that's the end of the regular session here. For those of you who are interested, we're going to do a quick little demo of Riskipedia.com. There's no need for you to stay with us, but we certainly would like it if you stayed and we gave a quick little demo of the system. So right now I'm going to share my screen. And once you log into our site, this is what you see. Stephen's book is just one of the many that we have. Plan Corrections eSource. We currently have one chapter loaded. As you can see, the navigation is quite straightforward. It's Q&A format, so I'm just going to show you a sample section here. A couple things to point out. The little question marks are the Ask the Author feature, where you can send in a question to our authors. Currently, Darren Watson is answering the questions. We answer them in 4 hours or less, and you have the benefit of it being answered by Darren or someone with a similar background. The other thing that we pride ourselves in the product is that anytime we make a statement, we generally back it up with a cite to IRS or DOL government source material. Here we're taking you directly to EPCRS so that you can read for yourself what Stephen is saying. The overall layout of the book will be similar to our Chapter 21 in the Qualified Plan eSource, where it's a functional view of issues. So if you have problems with 401k plans, you go to the 401k chapter. The other thing that we offer in the Qualified Plan eSource, and we haven't talked about this with Stephen yet, but possibly having some spreadsheets where people can go through a sample way of fixing a correction. So a sample here, we have ADP correction. Go ahead, Stephen.
Can I jump in, Tim?
Please jump in.
One of the things that I have providing some sample where I've actually completed the forms for correction, and I've got a fact pattern where I say, okay, this is the error, and let's say you're filing under VCP, and you say, okay, I want to know how I fill out the forms, which boxes I check, which documents or which forms, and so that is part of the plan. Oh, wow, excellent. So I think that's it for the demo. Thanks again. Thanks again for joining us. Appreciate your time. And Stephen, thank you very much. It was a great session.